Have you ever heard of an investing philosophy where less risk could actually mean a higher chance of hitting it big?
It almost sounds too good to be true, right?
It does. But that's exactly what we're diving into today, the world of Dhandho investing.
And to guide us on this deep dive, we're turning to Mohnish Pabrai's insightful book, The Dhandho Investor.
This book uncovers a fascinating approach to investing that emphasizes low risk and high returns. And get this, it's inspired by a very specific group of people.
A group known for their incredible success in, of all things, the motel business.
Okay, now you've got me intrigued. Who are these mystery motel moguls?
We're talking about the Gujarati Patels.
The Patels. Now, I know they own a ton of motels across the U.S., but how did they become so dominant in that industry? It seemed like a pretty tough business to conquer.
That's the amazing part. Their rise to motel-owning dominance happened in just a few decades. They went from owning practically 0 motels to having a majority stake in the market.
Wow, that's a meteoric rise. So how did they do it? What's their secret sauce?
Well, it all started with a story. This guy, everyone called him Papa Patel back in the early 70s. Picture this, recession's hitting everyone hard. And he comes across this motel that's just, well, distressed. They're practically giving it away.
Okay, how much are we talking about here?
$5,000.
$5,000. Seriously. I think I paid more for my last used car.
Exactly. It's a total steal. So Papa Patel, he scrapes together the money, gets some help from family, maybe takes out a small loan from the bank, and boom, he's officially a motel owner.
That's wild. But did it work out? I mean, buying a motel during a recession sounds like a gamble.
Here's where the Dhandho magic kicks in. He takes this tiny investment and turns it into a $20,000 annual return. That's a 400% return on his initial $5,000.
Okay, that's an incredible turnaround. But you're right, that does sound a little risky, putting everything on the line, especially during a recession. That takes some serious cuts.
It does, but here's the thing about Dhandho. It's not about completely eliminating risk. It's about minimizing it strategically while making sure your chances of hitting that big reward are as high as possible.
So it's more about calculated risks than blind leaps of faith.
Exactly. Now, even if the motel had failed, Papa Patel had very few personal assets to lose. He understood that going in. And the bank. They're incentivized for the motel to succeed, right? So they're going to work with him.
So it's like the odds were stacked in his favor from the start.
You got it. And even if it didn't pan out, he and his wife could always find other work. The point is, he wasn't just being brave, he was being smart about it.
That makes a lot of sense.
Yeah.
But there's got to be more to it than just minimizing risk, right? What's the Dhandho secret sauce here?
You hit the nail on the head. It's not just luck. It's a strategic approach, a way of thinking. Let's break down those Dhandho principles that were at play in Papa Patel's incredible story.
Okay, let's do it. I'm ready to uncover the secrets.
First, he invested in an existing business, that motel, something he understood with a proven track record. Then he kept his costs super low, which is a classic Patel trait, and this gave him a leg up on the competition. And finally, he had patience. The kind of patience you need to ride out the ups and downs that naturally come with any market.
And that patience paid off big time. I mean, he used the profits to buy another motel, bring his family into the business, and boom, just like that, a motel empire is born.
Exactly. And it just shows how a simple, clear approach can lead to extraordinary results.
It really is inspiring. And I bet there are tons of lessons here that anyone could apply to their own lives.
Absolutely. And it highlights how Dhandho is as much about mindset as it is about tactics. It's about being open to opportunities that others might miss, thinking long term, and accepting that, hey, even if things aren't perfect, your downside is limited.
So it's about taking calculated risks, not just jumping into the deep end without a plan.
Exactly.
But I'm curious, does this Dhandho magic only work with, say, motels? Or could these same principles be applied to, well, something bigger like building a massive company from scratch?
That's the beauty of Dhandho. It's not limited to one specific industry. It's about recognizing value where others don't, regardless of the business. And, there's a perfect example of this, Richard Branson.
Richard Branson. Oh, I see where you're going with this. Virgin Airlines. Talk about a household name.
Exactly. He's the embodiment of what we could call Virgin Dhandho. Built his entire empire by being resourceful and keeping his initial investments super low.
Okay, I'm all ears.
Yeah.
I mean, everyone knows Richard Branson. He's got his hands in everything, airlines, mobile phones, space travel, you name it. But didn't he start with practically nothing? How does that fit into this whole Dhandho framework?
Well, let's take Virgin Atlantic, for example. We're talking about the airline industry, right? One of the most expensive industries to break into.
Yeah, for sure. The planes alone must cost a fortune.
And that's not even counting the airport fees and all the other expenses that come with running an airline.
Exactly. So how did he swing that?
Instead of sinking tons of his own money into buying planes, building all the infrastructure from scratch, he found a way to launch with minimal personal capital. Classic Dhandho.
So how did he pull it off?
Well, first, he spotted a gap in the market. No discount airline was flying between London and New York. Then he managed to secure an incredible deal for a Boeing 747.
Wow. So he basically convinced Boeing to take on most of the initial risk. That's brilliant.
Exactly. It's that classic heads I win, tails I don't lose much philosophy that's at the heart of Dhandho. And it's something we see again and again in Branson's ventures.
So it's all about structuring those deals where the potential rewards are huge, but your personal risk is minimized. That's fascinating.
And this Virgin Dhandho approach, it's everywhere, like partnering with Sprint for Virgin Mobile to avoid building a whole network, or even launching that exclusive electronics line with Target instead of opening his own stores.
Okay, so we've got motels and airlines, two completely different industries, both achieving incredible success with this Dhandho approach. It really makes you wonder, can these principles be applied to any industry? Even something as, let's say, industrial as the steel industry.
Now, steel might seem a world away from discount airlines, but you'd be surprised. Dhandho has a way of showing up in the most unexpected places, and the steel industry is no exception.
Oh, I love that. So how does a Dhandho play out in the world of steel?
Well, let's talk about Lakshmi Mittal. He's a steel magnate who built a multi-billion-dollar empire, and he started with practically nothing.
Wait, from humble beginnings to a billion-dollar steel empire. Okay, now I need to hear this story. How did he use Dhandho to reach the top of the steel world?
Mittal's strategy was all about finding those diamonds in the rough. He specifically targeted distressed steel mills, run them for a fraction of their actual value.
It's like buying $1 for 50 cents, finding those incredible deals that everyone else is overlooking.
Exactly. One of the best examples of this is his acquisition of the Karmet Steelworks in Kazakhstan.
I've heard of Karmet. That's a massive operation, isn't it?
Massive and on the verge of collapse. But here is where Mittal's Dhandho instincts kicked in. Instead of seeing a lost cause, he saw an opportunity.
So instead of being intimidated by the challenges, he saw the potential.
That's amazing. Exactly. And he had the courage to act on it. He acquired Karmet for practically nothing. And get this, he kept the existing workforce, paid all the outstanding wages, and within a few years transformed the entire operation into a money-making machine.
Wow. So he didn't just buy a company, he revitalized a whole community.
Exactly. And, this wasn't just a one-time thing either. He applied the same Dhandho strategy to the Cydex steel plant in Romania and the Cebalsa mill in Mexico.
So his approach wasn't about building something from the ground up, but rather about strategically acquiring these undervalued assets, these hidden gems that everyone else was too afraid to touch. That's classic Dhandho.
It is. And, Mittal's journey highlights a key insight that's at the core of Dhandho. The biggest returns often hide in the places where everyone else sees only risk.
That is a powerful insight. And, it makes you wonder what undervalued assets might be hiding in plain sight in our own lives, right?
It really does. It begs the question, doesn't it? And we're going to delve into that a bit later. But first, let's shift gears for a moment and really break down the core Dhandho principles that fueled these incredible success stories, from those motels to those massive steel mills.
So we've seen how this Dhandho thinking is played out in these incredible stories. But what are the specific principles that make it work?
How can our listeners, start spotting these, distressed motel opportunities in your own world?
Yeah, even if you're not planning to buy a business tomorrow.
Exactly. That's the exciting part. These principles, they really translate far beyond just making financial investments. But let's start with how Dhandho applies to business.
Okay, sounds good.
One of the core tenets is investing in existing businesses, just like our motel-owning friend, Papa Patel.
Makes sense. You're stepping into something with a history. A track record seems less intimidating than starting from scratch.
Exactly. You can analyze past performance, understand the business model, and assess the value proposition more easily.
So fewer unknowns, which naturally reduces risk.
Precisely.
Okay, so less of a gamble, more of a calculated bet. But how do you determine if a business is a good bet? What are the key things to look for?
That's where the principle of simplicity comes in. Dhandho favors businesses that are easy to understand, where you can clearly see how the money is made.
Okay, so what kind of business are we talking about here? Give us an example.
A great example is a gas station. It's a straightforward model. You buy gas at one price, sell it at a slightly higher price, and manage the costs in between. Keep it simple. Keep it clear. It's about looking for those businesses that even I could wrap my head around.
Precisely.
I like it.
Now, even simple businesses can face competition. So another Dhandho principle is identifying companies with durable moats.
Durable moats? Is that like a metaphor for something?
It is. Think of a moat around a castle, protecting it from invaders.
Okay.
In business, a moat represents a unique advantage that protects a company from its competitors.
Gotcha. So give us an example of a company with a strong moat.
Take Chipotle, for example.
Yeah.
Their focus on fresh, customizable meals has created a loyal following, giving them a distinct advantage in the fast casual restaurant market.
That makes sense.
Another great example is Geico. Their direct-to-consumer model, bypassing traditional insurance agents, allows them to offer lower premiums, a significant competitive edge. So it's not just about finding a good deal. It's about finding a business that can sustain its success over the long haul.
Exactly.
But even if you've identified a promising opportunity, how do you decide how much to invest? How often to buy those? Seem like critical decisions.
Absolutely. And this is where we get to another core tenet of Dhandho, making few, large, infrequent bets.
That seems counterintuitive. Don't they say diversification is key?
It's not about putting all your eggs in one basket, but rather carefully selecting the baskets.
Okay, so you're still diversifying, but you're being more strategic about it.
Exactly. The Kelly formula, a mathematical formula for optimizing bet size, actually supports this approach.
Interesting.
It suggests maximizing returns while managing risk by making larger, less frequent investments when the odds are significantly in your favor.
So it's about being selective, waiting for those prime opportunities, and then being decisive when they arise.
Exactly. It's like going all in when you have a royal flush in poker, not throwing pennies at every hand.
I like that analogy.
Now, another important concept intertwined with this is arbitrage.
Arbitrage. That sounds complicated.
It's simpler than it sounds. Think of it like finding a rare antique at a flea market for a fraction of its real value.
Yeah.
That's arbitrage exploiting price discrepancies.
Gotcha.
Dhandho investors apply this principle to the market, finding those situations where an asset is significantly undervalued and capitalizing on that mispricing.
It's bargain hunting on a whole other level.
Exactly.
But how do you actually find those arbitrage opportunities in the market? It seems like everyone's looking for those hidden gems.
It takes research patience and a keen understanding of market dynamics.
Sure. Sometimes it's about recognizing when the market is overreacting to a short-term event. For example, a company might have a bad quarter, causing its stock price to plummet. Sure. Dhandho investors look beyond the headlines and analyze the underlying fundamentals if the core business is strong. They see this dip as a buying opportunity, knowing that the market often swings back to reflect true value.
So it's about tuning out the noise and focusing on the signal, looking for value where others see only risk.
Precisely. Now, this brings us to a crucial Dhandho principle that underpins all these strategies: margin of safety.
Margin of safety, that sounds important. Break it down for us.
Think of it as a financial cushion.
Okay.
It means buying an asset for significantly less than its intrinsic value, what you believe it's truly worth.
Okay.
It's a buffer against mistakes, unexpected events, or fluctuations in the market. So you're basically giving yourself some wiggle room.
Exactly. Warren Buffett, a legendary investor, is a huge proponent of this principle.
I've heard of him.
He once invested heavily in the Washington Post when its stock price was significantly lower than its intrinsic value. The price dropped even further after his initial purchase, but he wasn't fazed.
Wow.
He understood the company's true worth and had that margin of safety to cushion the blow.
And I'm guessing his patience paid off?
Absolutely. The stock eventually soared and his investment became a multi-billion-dollar holding. It's a testament to the power of margin of safety.
So even with the most careful analysis, you're acknowledging that you might be wrong and you're building in that buffer to protect yourself.
Exactly. It's about minimizing the downside, even in the face of uncertainty, which, by the way, is another element Dhandho investors embrace.
Wait, uncertainty. Aren't we trying to avoid that?
Here's the thing. Uncertainty often creates opportunities that others miss.
How so?
Think of it like this. When a company faces uncertainty, perhaps operating in a volatile industry or going through a period of rapid change, the market tends to overreact.
Makes sense.
Fear sets in, and investors shy away, often driving the price of the stock down further than it should go.
So you're saying that uncertainty can actually be a good thing for Dhandho investors, that it creates opportunities that other investors might miss because they're too focused on the short-term risks.
Exactly. When others see uncertainty and panic, Dhandho investors see potential bargains. But they don't just jump in blindly. Remember, they're still applying those other Dhandho principles we talked about.
Right, so they're focusing on those simple, easy-to-understand businesses with strong moats, and they're always making sure they've got that margin of safety built in.
Precisely. By sticking to those principles, they can minimize their downside even when there's a lot of uncertainty swirling around.
That makes a lot of sense. Do you have any examples of companies that were considered risky but turned out to be great Dhandho investments because of that uncertainty?
Absolutely. One great example is Stewart Enterprises.
Stewart Enterprises, what do they do?
They're a funeral service company.
Okay, interesting.
Yeah.
So how does a funeral home fit into the world of Dhandho investing?
Well, back in 2000, they were facing a mountain of debt. Their stock price was plummeting, Wall Street was freaking out, predicting bankruptcy. But the savvy Dhandho investors, they looked beyond the headlines.
What did they see that everyone else was missing?
They recognized that the core business itself, rock solid.
Because no matter what's happening in the stock market, people are still, well,
Exactly. People will always need funeral services. It's one of those essential, timeless businesses that's not going anywhere.
death and taxes, as they say.
Exactly. And Stewart Enterprises, they had a really strong market position within that industry.
So those Dhandho investors, they realized that the market was overreacting to the debt, and they saw an opportunity.
Precisely. They swooped in, bought the stock at a steep discount, and waited for the market to correct itself.
And I'm guessing that strategy paid off big time for them.
It did. Once the company got its debt under control and the market calmed down, the stock rebounded. Those who had the foresight to see the true value, even amidst all that uncertainty, they were rewarded handsomely.
It's another example of how Dhandho can lead to incredible returns if you're willing to think differently.
It is, and there are countless other examples like Stewart Enterprises,
Yeah.
Level 3 Communications, Frontline. These companies all faced massive uncertainty at one point or another, but Dhandho investors were able to capitalize on the mispricing that often comes with those situations.
So to sum it up, it seems like Dhandho isn't really about avoiding risk entirely. It's more about understanding it, measuring it, and then using that knowledge to your advantage.
You got it. It's about being strategic, being disciplined, and knowing that the biggest rewards often come with a certain amount of inherent risk.
It makes you realize that sometimes the greatest opportunities are the ones that other people are too afraid to even consider.
Absolutely. And, that's a principle that applies to so much more than just investing. It's a philosophy that can be applied to all aspects of life, your career, your relationships, your personal growth. It's about having the courage to bet on yourself, even when things are uncertain, and to see the potential where others see only risk.
That's a powerful message. So as we wrap up our deep dive today, what's the one key takeaway you want our listeners to remember?
I think the biggest lesson Dhandho teaches us is this. Don't be afraid to think differently. Don't be afraid to look for opportunities in unexpected places. And when you find an opportunity that aligns with your values and your goals and you've done your due diligence, don't be afraid to take that calculated risk.
That's great advice. So as you go about your day, your week, your life, remember the lessons of Dhandho. Look for those hidden gems, those undervalued assets, those untapped potentials. Be bold, be curious, and most importantly, don't be afraid to chart your own course.
Because you never know what amazing opportunities await when you start seeing the world through a Dhandho lens.
That's it for our deep dive today. Until next time, keep exploring, keep learning, and happy investing.